Hey everyone, it's Tom Kratz. I'm in the middle of your screen here. We're going to go over some of the factors that we look at that help us forecast where Toronto real estate prices are going to go next. We're going to cover some of the primary factors and one hidden reason that we don't think is discussed nearly enough, but is near and dear to our hearts. So let me just make myself a little smaller, put it in the corner. So here's the things that we're going to go over. We're going to go over demand, supply, cost of money with the unintended consequences of that cost, and the hidden reason that we think should be discussed more. I'm going to go pretty quick because I'm a little short for time here. So we're going to just dive into this. So here is some of the demand numbers. Our immigration targets are absolutely astronomical. They used to be about 300,000 a couple of years ago. Then we upped them to about 330,000. Now Canada has decided we're going to up it again to 400,000 in 2021, 411 in 2022, 421,000 in 2023. So our immigration targets in this country are absolutely huge. And this is not an anti-immigration rant by any means. Nick and I, my brother and I, are the product of two immigrants here in Canada. Our mother is from Scotland. Our father is from Croatia. They came to Canada. We would not exist without the country of Canada and without the immigration policies of Canada. So this is not an anti-immigration talk. This is just talking about some of the targets that Canada is putting in place for the country and what we're attracting in here. A lot of the media is going to say we are not going to hit this target this year. But if you look at some of the historic data, you realize that even when we're not hitting this target, it's still a huge number. So let me show you some of that. Here's some of the historic data. So if you can see here from about 2002 to 2012, we were getting about 250,000 people. And that was a large number because before that, we were barely getting close to that. For the decade or two before that, it was a little choppy, but we were not getting a steady flow of 250,000 people. So in the media over the next 6 months, we're likely going to see headlines around how Canada is not hitting its immigration target, which is 401,000. And it looks like it's forecasted to be 270,000. So what those headlines will not share with you is that 270,000 this year in 2021 is likely still larger than what we got throughout the last decade or so from 2002 to 2012. So this is some data from Stats Canada that's been archived now. So even if we miss, we're still going to be above what we did historically. So here's what is going to happen in Ontario. This is from the Ontario government's website, some of their forecasting and planning. The URL is right here if you want to check some of this data out yourself. But look at what Ontario is projecting going forward to 2046. An absolute a steady annual wave of immigration. And they always project these things too low. We think this should actually be higher. We get in this province of Ontario about 44% of all of Canada's immigration. So we think this number is actually low based on Canada's new immigration targets, and this will be raised. So this is, even if it's not raised though, look at the wave of population growth coming to Ontario. So the demand in Canada because of immigration and then in Ontario looks like to us it's going to be a steady flow of new population growth unlike we have ever seen before. So that is the demand side. Now let's flip over and look at, I was going to say the supply, but I want to share with you one thing. All of these policies here in Canada have made Toronto specifically the fastest growing city in North America. And I'm not sure everybody's aware of that. If you look at some of the numbers comparing Toronto to some different American cities that are growing quite quickly, Toronto is growing at an absolutely astonishing rate. There's a better chart down here that shows you Toronto compared to some other cities here. And look at the amount of Toronto's population growth compared to some other American cities. Toronto is growing at a rate, and I don't think this is discussed in the media nearly enough. We are growing at a rate faster than any other city in North America. The population, the last time I checked, the population of New York and Chicago are both decreasing, the large cities in the US. We are increasing at a huge rate. So this is the demand side. So now let's flip over to the supply side. On the supply side, I love Ben Rabidou's data here. Ben Rabidou, if you're not following him on Twitter, you absolutely should. He shares some absolutely great data. Take a look at the data he's sharing here. Population growth versus new single-family home completions over the decades. Now, this is really insightful. In the 70s, we had 3 million people as a new population growth, and then we built 1.4 million new single-family homes to support that. In the 80s, we had a 3 million people population growth. We built 1.2 million single-family homes. In the 90s, 3 million people again. We built 1.1 million new single-family homes. In the 2000s, slightly over 3 million, 3.2, and we built 1.39 million single family homes. And then look at the last decade. We hit almost 4 million people as population growth, but we only built just over 1 million single family homes, which is an actual decrease from the previous 4 decades. So we had a 33% increase in population growth, and we slowed down our build of new single family homes. It doesn't take, and we don't need to be rocket scientists to understand when you have more demand and less supply, here's what's going to happen. It's almost as if someone in the country of Canada, when they decide on some of these new population and immigration targets, should work with the province and municipalities a little bit more aggressively to share that information so that we really promote developers and encourage developers and have maybe less regulations to allow developers to build. So here is some other data showing single family homes coming down since 2005. Some of that supply side has been made up through condos and some purpose-built rentals, but it's clearly not enough because eventually when somebody moves into a condo and has a family, they typically eventually want to move out into some sort of single family home, whether it's a townhome, a semi-detached, a fully detached single family home. And when the supply is coming down like that, it's just naturally going to put pressure on prices. And I want to show you one other data point on that actually. Let me see if I have it here, which I do. This is from Ben Rabidou's service, edgeanalytics.ca. Highly recommend his stuff. And this chart is where it's laid out really nicely. It's the same data he shared on Twitter, but in a chart format. And you can see the blue line here is single family home completions, and there's population growth. And you can kind of see it over the decades, and then take a look. Here's the last decade. Look at our population growth compared to the previous 4 decades, and then look at our single family home completions compared to the previous 4 decades. So it's just a natural supply-demand situation where the cost of single-family homes is going to increase because of the demand for them. So now let's flip over. Oh, one last thing. Ryerson has this great report. It's my favorite report from them from about 2 months ago. It's called the GTA Housing Pulse. It's their March report. And if you take a look at this report, let me scroll up to it really quickly here. Look at the average annual growth in households by housing region. So over the last, this is the last decade. So from 2011 to 2016, we had, 45,000 household formations per year in the greater Golden Horseshoe. And the previous 5 years, we had about 50,000, just over 50. And what's forecasted for the next 10 years, this is a per year number, is that we're going to have about 70,000 new household formations in the greater Golden Horseshoe. And they go into the report here, the URL's up here if you want it. They go into the report that it's demographics, not just immigration. We have the millennials now who are starting to buy, who are forming families and starting to buy. So when you pile in immigration and millennials that are buying, the household formation here is about to go higher. So not only do we see demand side from the immigration numbers, if you look at the household formation forecast, it looks like it really is going to be true where we have demand increasing over the next 10 years. So if we do not increase supply rather quickly in this area, it seems pretty obvious to us that prices are going to inch forward. And a lot of that is dependent on incomes. Are the banks going to continue to lend? So there are definitely other variables, but purely on supply and demand, this looks like the demand for single-family homes is clearly going to increase in this area. And so this brings us to our next factor. So we looked at some supply, we looked at some demand data. Now I want to look at the cost of money. When the cost of money is this low, so over a decade, we've had interest rates below 5%. For a decade, you could get interest rates, you can get a mortgage for pretty much 3% or less for almost a decade. There was a little spike here, but you can get interest rates really low. Historically, that is super low if you go back in time here. Our parents in Mississauga had an interest rate on their mortgage on their Mississauga home at 16.5% interest in the 1980s. So when you do a decade of cheap money like this, there's a bunch of unintended consequences. The first is when people are going to buy homes, and you drop interest rates, something interesting happens. So here's a TD mortgage calculator that I brought up. And when you could get a $400,000 mortgage at 2.7% interest about a year and a half ago, that would cost you $1,966. But then when interest rates are dropped, and they were dropped because of COVID, and they're just pushed down, and you could get a mortgage instead of 2.7%, you can get it for 1.5% if you're on a variable rate. There was a while that you could actually get it for 0.99% from HSBC. But that same $400,000 mortgage is now not $1,966 or whatever it was. It's $1,733. So it's substantially less. But what we find in the real estate market is people don't accept the lower payment and stick with the $400,000 mortgage. What most Canadians do is they say, oh my gosh, I was about to get a mortgage at 1966, but now that interest rates fell and the cost of that mortgage is 1733, I'm actually going to get a $450,000 mortgage because the $450,000 mortgage is about the same price as the $400,000 mortgage at 2.7%. But now because interest rates are lower, I can afford more mortgage and the monthly payment is about the same or even slightly less than I was expecting. So now the same person that was shopping for a property doesn't have a $400,000 mortgage to play with, they have $450,000. And this drives the real estate market. So when the government of Canada and the Bank of Canada decide they're going to drop rates, the unintended consequences are that everybody can afford a higher monthly payment. It pushes more money into the market, driving real estate prices. I don't think the government understands that they're not really helping when they drop interest rates. This really pushes prices in the real estate market, and the further unintended consequences are stuff like this. In the US, Blackrock has been taking a lot of heat because they're a big hedge fund Goliath that has been buying swaths of single-family homes and turning them into rental properties throughout the US for about 5 or 6 years now. And this article is actually kind of defending them a little bit, saying BlackRock is not ruining the U.S. housing market. You know, they're basically saying the U.S. needs to create more supply. And everyone's arguing whether this is right or wrong. But the fact is that big money is looking for a return. And when interest rates are pushed down artificially low, like they have been, then you get unintended consequences where you have hedge fund money piling in to the real estate market. And the same thing has happened here in Canada, which is causing a big debate. I'm sure everybody's seen this one at this point. This is the condo developer plans to buy $1 billion worth of single-family homes in Canada. So this is where money is searching for yield. And that the reason that this is going to continue is because you have governments who keep spending money at an alarming rate. This is a chart of the Canadian deficit. And the Canadian deficit, here's deficit over, the last decade, and then COVID hit, and we had this astronomical deficit. Now the forecast for next year is that we're going to have about $120 billion deficit, so it'll be like in this range here. And then there's 20 or 30 billion that's not accounted for yet, so it actually might be higher than that. So we're actually running these massive deficits. So we have to keep interest rates low in this country to afford the interest on our own debt. And if I show you a chart here, I actually have another chart that will show you, here's a bunch of debt at the federal level. Look at the provincial debt. The provincial debt for 2021 to 2022 is $30 billion. That might not seem a lot until you understand that our federal debt, our federal deficit, this is the annual deficit, this is the annual deficit. We are short $30 billion this year in Ontario. The annual deficit for the country of Canada was $34 billion before COVID hit. Now the annual deficit for one province is $30 billion. So the amount of money and unintended consequences that come for this with low interest rates drive all these things where people buy more real estate because they're just focused on the monthly rate. It pushes big hedge fund money into the real estate market. So you have all these unintended consequences. And let me transition over to one more thing here. Here's what I really wanted to, this is the fourth factor. So what we've talked about so far has been supply and demand, and then we've looked at cheap money or the cost of money and the unintended consequences of the cost of money that drive the real estate prices. So those are the main factors. So when we see the headlines, when everyone's talking about, what's happening in the real estate market, why is it going up? It's those are the primary factors. But here's another factor that is kind of hidden that is really driving things. This is the amount of currency, or M2. It's referred to M2 technically, but it's the amount of dollars in the economy. It increased in the last year by about 20%. because of all the different stimulus programs that we had. The government just created new dollars and shoved it into the economy. Here is why this is really important. When I was in grade school, if there was 10 Wayne Gretzky rookie cards at school and somebody had a really nice BMX bike, they might actually exchange their BMX bike for one of those really prized Wayne Gretzky rookie cards. There was only 10. There might have been like 10,000 NHL cards in school. But if you were one of the lucky ones that had a Wayne Gretzky rookie card, you knew you had something of value. And if you saw somebody with a nice bike, they might actually say, hey, if you give me your Wayne Gretzky rookie card, you can have my bike. That would be the exchange. But then if somebody came to school the next day with a bunch more Wayne Gretzky rookie cards, and at recess there wasn't 10, there was 12, 14, 15, 20, 30 Wayne Gretzky rookie cards. All of a sudden, the person with the BMX bike might say, whoa, hold on a second. It's not going to cost you one Wayne Gretzky rookie card. I know there's more in school now. Give me 2 or 3 of those Wayne Gretzky rookie cards. So what happened there? Did the BMX bike change? No. The value of the Wayne Gretzky rookie cards changed because more came into the system at school. The same thing is happening in Canada here, whereas the real estate is not changing. My house, your neighbor's house did not change. So when everybody says the price went up, to us, they're looking at things incorrectly. What's happened is more Canadian dollars have been stuffed into the economy. It decreases the value of money in your pocket and my pocket, decreases the value of anyone's income who's not adjusted because of this. And when more dollars are shoved into the system, the real estate didn't change. What's happening is just people who are selling the real estate can ask and get more dollars for their property because the value of the dollars is decreasing because the price is spiking. The quantity of dollars is spiking up the way it is. So the hidden factor in the real estate market is that there are more dollars printed out of thin air, digitally created and stuffed into the economy. And the real estate has not changed. It's just that there's a larger quantity of dollars chasing it. The value of the dollars are decreasing because there's more created artificially and pushed into the system. This is the hidden factor that the governments don't want to talk about because this is how they fund those deficits that we just talked about. They print money. And when you print money at this scale and push it into the economy, naturally, the value of the dollars that are already there decrease, and whoever's selling a good, hard, scarce asset like a single-family home can ask for more dollars and get it. So this is a very misunderstood thing. To us, it is the hidden reason of the real estate market and why prices go up that nobody discusses. But when you put all of these things together, this gives us clues to where things are going to go next. Because we don't think deficits are going to slow down. We think they're going to continue to be huge at the federal level and the provincial level. It looks like demand is going to stay high. Supply does not look like it's increasing. The next 10 years are going to be rather interesting in this area. So hopefully that gives you a few things to think about. That's it for this time. Until next time, your life, your terms.